Clients often ask the question, should I invest in a real estate investment trust? Will that help diversify my portfolio? Will it help my returns? We're going to dive into those questions today.
All right, so Spencer, as we talk about other types of investments, we talked about gold in our last episode. We'll look at other different investment opportunities, alternative type of investments that are different from the stock market and the bond market. You want to walk us through what is a real estate investment trust or a REIT?
Yeah, a real estate investment trust is basically a vehicle that companies can use to have a diversified portfolio of real estate holdings. Sometimes these REITs are publicly traded, sometimes they are privately held, but generally speaking, they're set up in a structure that is efficient for pushing out the income that comes from owning real estate and the rents that come from real estate and pushing those out to investors. So there's some advantages certainly to a real estate investment trust, but we also have to look soberly about whether they really are an investment that helps us beyond a publicly traded stock or bond.
Okay, so as we think about what are some of those benefits? What are the reasons why you would consider owning a REIT?
Well, one of the things with real estate investment trusts, particularly in certain sectors of real estate, because we also have to recognize that not all real estate investment trusts are the same. There can be real estate investment trusts that look at the commercial side of real estate. There can be those that are really focused on a subset there that look at, say, medical buildings. There are others that look at multifamily rental homes, type of situation. So all kinds of different REITs that are out there. But one of those key reasons that we hear so much of is, well, this real estate investment trust, it's going to pay out 4 or 5 or 6% as an income stream based on the rents that are there. So income generation is one of those features that sometimes people will cite for a consistent rate of return. Now, the thing that we have to grapple with is just because we get a consistent level of income doesn't mean that the REIT itself will give a rate of return, a total rate of return on an annual basis that is consistent. We might have dividends that are paid out 4 or 5%, but the price of the REIT that's publicly traded could drop 10, 15, 20%. So that doesn't really feel very good for a lot of investors who say, okay, well, I got the cash out, but my value just plummeted here. Right. So we have to think about both the income generation, but also the price of the REIT if we're looking to resell it, or the potential that we might need to rebalance a portfolio.
Yeah. One of the other benefits that I think a lot of clients look to REITs towards is maybe they want to get into real estate, but they don't have $5-10 million to invest in commercial properties. And so it allows them to invest in real estate and have liquidity in that investment, that they don't have to be the owner of the property. And they can also diversify across a lot of different properties. So you want to walk us through a little bit more of those benefits.
Yeah, so particularly for these publicly traded real estate investment trusts that might be in an ETF format in particular, or might be purchased through a mutual fund type of format that would diversify even across a number of different real estate investment trusts. You can have a level of liquidity there, or if you even just went with an individual REIT, again, that would be publicly traded, there's a level of liquidity. So it can be bought or sold oftentimes in the public markets, every day of the work week, basically there. So that can be a nice feature to it, and you can own a diversified set of holdings. Like you said, you might own one small part in thousands of buildings around the country that are all in a particular sector, or it might just be a diversified REIT there. So for folks that say, hey, I really want to increase my investment in real estate, this can be one of those paths. Now, we need to have an idea about real estate of why we want to hold real estate basically versus maybe a U.S. stock or bond or what have you there, because there are trade-offs that we have to face there. But for people that want to increase that exposure to real estate in general, and they've got a thesis that, hey, real estate's going to do well over the next 10 years, I want to own a real estate investment trust, you can do that in a publicly traded way with liquidity.
Yeah. So let's talk about the diversification within a portfolio. So we have clients that have stocks and bonds. They say, I want to add REITs for some diversification to that portfolio, not have everything in the stock market or everything in the bond market, or just in those two segments. Where do REITs help us here?
Well, they don't move in lockstep typically with stocks or bonds. So they're a little bit different than stocks, although they are somewhat correlated with stocks. they move in a similar pattern, but not the same pattern. So depending on what statistics you're looking at, they're probably something like 70 to 80% correlated with US stocks. But because they're a little more sensitive to interest rates, they are not going to be perfectly correlated with US stocks. Yeah. There would be a little bit more correlation with US bonds, say, than typically stocks would have with bonds there, because bonds are also sensitive to interest rates. So they're somewhere kind of in between there, but they're much more correlated to US stocks than, say, a 10-year Treasury bond.
Okay, yeah, that's great. So what about inflation? How does a REIT help us in terms of an inflationary environment?
Well, if we have an inflationary environment, typically what will happen is the cost of living is going to go up overall, but part of what happens there is real estate investment trusts own real estate properties that increase their rents oftentimes. Now, this is not across every REIT. You do have some REITs that are just hold corporate headquarter buildings, for instance, that might be locked in for the next 10, 15, 20 years even with a large company that has a contract that the cost is going to increase on a 2% level every year. Mm-hmm. So there will be some cost of living adjustment, some increase in rent, but it will be modest relative to if we, say, had an 8% inflation spike like we did a couple of years ago. It's not going to adjust perfectly. Now, on the flip side of things, we might have REITs that, if we're thinking about multifamily housing REITs, oftentimes those would be able to increase their rents, maybe not in lockstep with inflation, but much more closely anchored to inflation.
Yeah.
So that can be helpful because if the rent increase, then the dividend typically will increase.
Right. Well, and coming back to the conversation that we had on rental real estate, one of the big challenges that we face there is the management of the real estate. Right. So talk us through what's the benefit of professional management within a REIT.
Well, it's a trade-off there. Certainly the benefit is that you're not taking care of it. When the tenant who's on the fourth floor at the end of the hall has, the water line break on them, you're not responding to that. Mm-hmm. You're probably not even seeing that in the prospectus because you have several layers of management that are dealing with that. Now, the bad news is that there's also a cost to that management. So there's a situation that this is much closer to a U.S. stock or bond that's publicly traded, that you're not going to have to get involved in the management of the company. Your time is not going to be taken by that professional management. So on the balance, the diversification and professional management is probably a good thing, but we have to recognize the trade-offs.
Yeah. All right, so let's shift over and talk about some of the downsides. What are maybe some of the first things that people need to be cautious of as they explore REIT investments?
I think psychologically, people think real estate is fairly stable in value, and so the price of that real estate investment trust will be fairly stable in value, and that's not necessarily the case. Real estate in general, it can be relatively stable in value, but oftentimes it's not. We can see whether it's residential properties or commercial properties go up and down significantly in value. And these real estate investment trusts, they are priced on a day-to-day basis. They are, the assets, they're going to be traded up and down. So if we have a real estate investment trust, traders are going to be assigning a value to that. There's going to be a bid, an ask, spread, just like any kind of publicly traded stock. So if we look at the volatility, actually, rather than them being less volatile, if we look at the last 15 years, they've actually been a touch more volatile than large U.S. companies over that time. And some of that has to do with the interest rate environment that we've been in, where interest rates move, up and down, and that has a significant bearing on a lot of these real estate investment trusts because some of them have leverage in them. And so as we see interest rates move up, particularly if there's some variability to the rates, then these companies are not going to be making as much money because their cost of capital is increasing substantially there. So they're not necessarily less volatile than U.S. large stocks. They've even been a little bit more volatile over the last 15 years than U.S. small cap stocks. So not necessarily less volatility, a little bit different correlation. And so if we put them into a portfolio, sometimes the overall portfolio level of volatility can come down a little bit, but not much. Because when the stock market craters, typically the real estate investment trust market is also going to take some lumps. We think about the COVID lockdown, for instance. REITs got smoked in that environment. We think about the global financial crisis of 2008 and 2009. They got smoked in that environment as well. So one of the things that you'd say is all risk assets correlation goes to 1 in the midst of big downturns like this. And it's not always true, but that is typically the case. When we have a big market downturn, there's some kind of a crisis, REITs are going to line up pretty closely with U.S. stocks in terms of the drop that they have.
Yeah. Okay. So let's talk about exposure to real estate. How much exposure, if someone really wants to go in this direction, is maybe an overexposure in this regard? Well,
we think about where REITs are at with the publicly traded U.S. stock market environment. And, the exposure that would be typical, say, in an S&P 500 index would be 2 or 3% of the portfolio would be in a real estate company or real estate investment trust type of investment. So typically we wouldn't go beyond 10% of a portfolio being in a REIT. So certainly, would be more comfortable with something like, 2, 3, 5%, of a portfolio if a client wants to go in that direction, but also would be equally fine with having very, very little exposure, 0. If a client wants to go in that direction, because most of the clients that we serve have real estate already. They own their home. And so there is some exposure that they have to real estate from that. Now, it's a little bit different than real estate investment trust because it's commercial property typically versus residential property, but it's still real estate. And, if we think about a client that has a portfolio that might have $2 million, but they have $750,000 in terms of the value of their home, well, they've already got at least a third of their portfolio that is in a real estate type of investment there.
Yeah. All right. So Spencer, you mentioned earlier about interest rates and the sensitivity that REITs have to interest rates. Can you expound on that a little bit more for us?
Well, and this is one of those reasons, again, to be cautious about our investments with REITs and just to at least understand the factors that are going on here. So you have an investment in these real estate properties. Sometimes there's leverage involved. And so you have, loans that a company will take out to be able to purchase, some additional properties. The challenge with interest rate sensitivity is if interest rates rise and cut into the profits there, it's more of a severe effect than what we would find with most companies. There is a higher level of leverage. There's a higher level of interest rate sensitivity because it's not just what those companies might be invested in today. It's also, they got some additional funds, that were provided to the REIT or, would be made available. Now they get to go out and they get to buy another property. If their first 100 properties that they bought, there was some level of financing that was at 4%, and now we've got financing at 7 or 8%, it's just less profitable. So what we find is that we're actually in a great environment if we see interest rates coming down with REITs, because the initial investment was made. As interest rates come down, actually that oftentimes will push the property value up and it will make financing costs less. So if we look at, say, from 2000 to 2010, REITs looked really good in their rate of return versus U.S. stocks. And one of the reasons was that we saw interest rates coming down, stair-stepping their way down. U.S. stocks, that decade was kind of the lost decade of investment returns because we had the technology bubble, in 2000, and we had a couple of different downturns in that time frame. So U.S. stocks basically were flat for an entire decade, whereas REITs did really well, again, because they're already paying that dividend, and we saw interest rates come down, and we saw a nice, healthy rate of return in there. Fast forward, from 2010 all the way up to present day, the last 14, 15 years of time from really 2009 onward, we've not seen REITs perform nearly as well because the interest rate environment has not been dropping constantly over time. It was higher in 2009. Over time, it dropped to a low point in 2020, and then the interest rate environment has rebounded. So that's put more pressure on REITs than it has U.S. stocks, because they have more variable loan financing oftentimes that they've got to deal with. It's also a forward-looking mechanism. So when we think about interest rate sensitivity, it's going to be much more of a factor in driving returns than we would say for the stock market. So we really want to be thoughtful about where we're at in an interest rate environment before we take an overweight position there in REITs relative to maybe a core target position there.
Yeah. All right, so Spencer, you mentioned earlier the benefit of not being the property manager. Can be some downsides to that too. Mm-hmm. There's a loss of control. Talk us through maybe some of those downsides to not being the property manager within a REIT.
Well, we have to understand also the different kinds of REITs that are out there. We're not the property manager really ever of the REIT, and that's probably a good thing on the balance. One of the trade-offs that we have to recognize, though, is that there are different types of REITs out there. There are some that are publicly traded, and there are ways, of course, that we can have investments in mutual funds or ETFs that even take a number of REITs and put them together, so we're even more diversified in our real estate holdings. But there are others that are illiquid. And oftentimes these are sold by financial professionals, and sometimes it's kind of the Hotel California effect. You can check out anytime you like, but you can never leave that investment. And it is difficult because they will not buy back shares in an efficient way. And so we have to be really careful about the different kinds of REITs that are out there, because we've seen many examples where the period that funds are locked up might be for 7 years or 10 years. Or we've seen circumstances where clients legitimately cannot get out of the REIT except taking a significant haircut to have share repurchase. So sometimes they say, well, you're going to get a level of dividend for an indefinite period until the REIT closes. So you might get a dividend that is 5 or 6% on an annual basis, and that might be sold as a financial professional. Someone might be saying, well, this is an amazing dividend. You're going to get this every year going forward. Okay, well, what happens when you want the principal back?
Yeah.
Sometimes there's a period there where there's a lock-up period where it might be 7 years and you can get it back fairly efficiently at a net asset value after 7 years or something like that. But we have seen circumstances, again, where clients really cannot get their funds back without taking a significant haircut because there's no one on the other side that wants to purchase their shares, and the fund does not want to redeem their shares. So you've got to be really careful about those different types of real estate investment trusts, those that are publicly traded securities, and those particularly that are held within mutual funds or ETFs that are very liquid. We don't have those same qualms about, but that's not the only kind of real estate investment trust that's out there. And if you have a financial professional that is pushing you hard to buy a real estate investment trust, usually there's a lockup period and there's a commission that the financial professional is really pushing you towards. That's not something that we're a part of. Here with our team, the REITs that clients would buy in a particular portfolio would be those that would be liquid, but you have to be very, very careful as you approach this.
Yeah. All right, so let's round this out with fees, expenses, and taxes. So just walk us through what are some things that we need to be aware of when looking at the different, let's say, publicly traded REITs.
Right, so a publicly traded REIT, you're going to have some kind of an internal management expense. That's going to typically be disclosed within the offering set. If it's an individual REIT, then you're going to have some kind of management expense that they're disclosing. If you have a mutual fund or an ETF that has a basket of these REITs, then they're going to have their own management expense to that. There's going to be an increased level of diversification typically, of those. But from a tax standpoint, things are a little bit different, and sometimes they can be unexpected for clients with respect to REITs because you're going to get a level of income. One of the ways that REITs are set up, one of the laws that allowed REITs to be formed is that you've got to push out at least 90% of the income to investors on an annual basis. So this is good in that there's a pass-through capacity comes to investors. You're not taxed at a corporate level and then passed out to investors, which is nice. But that pass-through means that you're going to get income, and it's typically income that is declared as ordinary income to you when you get that 1099 if you have it in an individual non-qualified account or a joint non-qualified account for that matter. So oftentimes if we have a capacity, what we want to do is our real estate investment trusts, we want to hold in a traditional IRA or a Roth IRA or some kind of tax-advantaged vehicle. Could even be a variable annuity, a flat fee, non-qualified variable annuity there that does not pass out income to investors every year. Because if we have a choice, we would prefer not to have a level of distribution that might be 5 or 6% per year that is taxed at ordinary income. We would far prefer to have non-qualified resources maybe invested in stocks that are you're getting a different level of treatment of taxation. When we think about the stock dividends, if they're qualified dividends, they're typically taxed at a lower level. If we think about long-term capital gains, again, taxed at a lower level typically than the ordinary income that we would get from REITs. So if we, again, the key thing is if we want to put REITs into an investment portfolio, if we have the opportunity, oftentimes into a Roth or a traditional IRA rather than a non-qualified type of account.
Great. Well, thanks for walking us through those REIT investments and the different options that clients do have. Clients, if you do want to reach out to us and talk about real estate within your portfolio, we would love to have a conversation with you. Until next time, take care.
If you like these financial planning videos, please share it with a friend, and if you have questions, go to our website at SiriusRetirement.com.
This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SiriusRetirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.